Okay, welcome to another run through of the top 5 charts of the week, but something a little bit unusual this week, and something that's pretty cool, is this first line here. Pleased to announce that Top Down Charts has turned 2 years old last week. So it's been 2 years since I started the business, and I've put a little bit of a link here, a bit of a blog on my reflections of the first 2 years in business. So I highly encourage you to take a look at that. If there's enough interest, I might do a bit of a talk on YouTube to expand on some of that, but otherwise let's get straight into it. For chart 1 is global equities country breadth, and just to first quickly explain what we're looking at here, in the red line that is the percentage of countries or markets that are trading above their 200-day moving average. It's 70 countries that we look at on this, and basically you can see that it's about 20 odd percent, so basically in the 20s there, so only 20% of those countries are trading above their 200-day moving average. Why the 200-day moving average? Well, it's a rough proxy for whether a market is in an uptrend or downtrend, whether it's above or below that. I mean, obviously there's markets where it's not or there's situations when a market is not trending, and you're going to get a whole bunch of false signals and no indicator is perfect. But if you look at the history of this chart, so we're showing it against the MSCI Equity, or All Countries World Index, and most of the time when that was strongly trending, you could see that this indicator was towards the upper end of the range there, around towards that 100% point. Indicators like this can provide a bit of a heads up or an early warning indicator at times. You can see there in the lead up to the financial crisis, we saw this indicator drop off increasingly actually before things really got ugly. And even in this most recent correction, there was a bit of bearish divergence there. We did get a bit of a weird sort of spike there, which kind of screwed with that signal, but for the most part it's I mean, when you're looking at the percentage of countries across the world that are in a downtrend, what this can do is basically flag when there is multiple issues going on, or issues going on with a certain set of countries. And I think that that's what we're looking at here. So and the reason why I included this chart is because the breadth indicators dropped down to levels that we last saw just into the early days of the 2015-16 corrections. So I think basically this reflects the weakness across the globe. Now I don't have the chart on hand here, but I could probably post it later. If you look at MSCI All Countries World Index excluding US, it actually looks almost the same as that red line. So what's really holding this all together at the moment is the US and tech as well. I mean, I saw somebody talking the other day saying, wondering, is US tech stocks the canary in the coal mine? But I think a more accurate statement is that they are the coal mine, and they are the main thing holding it together at the moment. So it's one to keep an eye on, and I think just being mindful of that weakness is pretty important. I mean, the other thing that this kind of indicator does do is give you overbought or oversold signals as well. So you can see there when it was at its worst in 2009, 2011, and even in 2016 when it was at its worst, that was actually proved to be decent buying opportunities. Of course, when we had that more steady bear market of 2000 to 2003, what it did was weaken down to those weak breadth levels across countries and stayed around that level. This is one to be cautionary note there. Policy uncertainty and volatility. So what we're looking at here in the blue line is the Global Average Economic Policy Uncertainty Index. It's put together by the guys here at policyuncertainty.com. and it is an index that uses algorithms to read newspapers and decide whether the level of economic policy uncertainty is high or low. And you can see there that it's been very high in recent years, and there's a pretty good reason for that. We've had a bunch of sort of political upsets like Brexit, Trump, a bunch of other populist kind of movements. Then we've had, indeed, a ramp up of stimulus in the early stages of that, and now, we're going the opposite direction in stimulus. So central bank policy is definitely a source of uncertainty here, and I would say that that point is definitely worth labouring. So if you think about the Fed, at least, the Fed is increasingly aggressively tightening, so both moving into quantitative tightening and rate hikes, and that's actually forcing a lot of emerging market central banks to go into tightening or hiking mode as well. And even you look at the Bank of Japan. Bank of Japan is in taper mode, so is the ECB. So we're moving from an environment where central bank policy, for the most part, was a force for repressing or suppressing volatility. And I think that, if you look at the gap in this chart here, that can be explained probably in good part by the fact that central banks were actually suppressing volatility. But I think that, if they were a headwind to volatility, they're going to be a tailwind to volatility from here as they transition from stimulus to tightening, or at least they move down the path of normalization. And I don't think that's something that people have really come to grips with yet. The moment that people really start to appreciate the importance of that is probably going to be too late. Moving on to the next one, very similar. This is global equity volatility. It's the average across every country that calculates it, and it's shown against the MSCI ACWI again. Now, this one is one that I included in the charts to watch for 2018 back at the turn of the year. That was before that little spike there, so with the benefit of hindsight, the inclusion of that chart looked pretty clever. But what I was thinking about at that time was, number one, that central bank theme, so the transition from stimulus to at least to normalization, basically a turning of the tides in global monetary policy. It's been a really critical theme. The other one, more so at the time, was the level or the extent to which valuations had become pretty elevated, and then also just the maturing of the business cycle. So that's why I think that with this chart we've seen a cycle low or cycle bottom in equity volatility, and from here, maybe it doesn't go straight up, but I think that this is the process of bottoming, and that we do see an uptrend in volatility from here. Very quick passing note on this one. So I was looking through the Global Cross Asset Market Monitor. It's a weekly chart pack that I put out, and it just covers basically all the key global markets, major asset classes, everything from fixed income, commodities, credit, equities. And on equities, got the DAX here, and you can see there that we've got a head and shoulders sort of situation turning up. I hesitate to call it a head and shoulders top, because you can really only call it a head and shoulders top once it's actually been and established as a top. So sometimes head and shoulders can work as a continuation pattern. But anyway, the line in the sand here is, if you can see where I'm placing my mouse cursor, sort of around there, and if we get a break of the neckline, then that would open up a move down, probably down towards the lows that we saw before quantitative easing in Europe, and that would be pretty important risk there, because if the German stock market was to fall over like that, then I think that would be both symptomatic of wider issues in Europe, and also be a source of adverse sentiment effects across Europe. So it's a key chart from a risk management standpoint, I think. And actually, on the topic of the cross-asset market monitor, the other market we're seeing a similar pattern is in Brazil's market, the Bovespa. So it's one to be mindful of. And the last one is gold. Now what we've got here in the red line is the speculative futures positioning indicator, and that is non-commercial longs minus shorts and standardized against open interest. You standardized against open interest to give a more comparable kind of, or to standardize it to make it more comparable across time, because what you find with futures markets, or any market really, is that it tends to grow across time. Assets under management rise. So if assets under management rise, then 1% position of a portfolio is going to be much larger than it was back in history. So I mean, to throw a number around, right, if your assets under management, if the assets under management of traders doubles across a 20-year period, and they're only trading a 1% position, well, that 1% position has doubled in nominal terms. And there's also just the development and uptake of that that kind of instrument. So that's why I think it's wrong to use the absolute level of longs and shorts, or longs minus shorts, as a main source of insight. And I mean, you definitely look at it, and it's certainly worth considering the absolute levels, but I think standardizing indicators, particularly in this case, really does help. And with all that said, what we've got is markets moved from considerably long, and also it's moved from consistently long, basically. So you can see that from early 2000 all the way through until the last couple of weeks, the habit was for traders to be on average net long, so speculators, non-commercials. And then we've moved back to this situation where it was almost structurally net short during the late 90s. And there's a good reason for that. I mean, we had this massive bull market in the 2000s there, so it's just good sense. It's just intelligent investing, I suppose, that you would be long most of the time during that period. And then I guess there's a bit of wishful thinking in more recent times when the market's been in more of a downtrend. But if you go back to the late 90s, there was a bear market in gold. And, obviously opportunities come out of bear markets, but it took a while and a series of extreme readings to the short side before a base was, proper medium-term base was established there. And I think that given the still considerable headwinds to gold, that yes, this could be a contrarian signal very short term, but I think it just marks a bit of a capitulation from the bulls there, or the traders in general, that the headwinds are mounting for gold. It's overvalued. The US dollar's strengthening. The Fed's doing quantitative tightening. These are among the factors that make me think that the weighted risks for gold are still to the downside. Could be wrong, and we could get some flare-ups in risk that could drive a bit of temporary demand, but that is what I'm seeing, and I try to look at the facts and try to rely on indicators and still make a judgment, but make a judgment based on what I see, not what I want to see, which don't think I can say the same about some of the other gold enthusiasts out there, but that's what makes a market. So that's it for this week. If you've got any comments, questions, complaints, maybe we'll have some of the gold guys come out and complain about that last chart. Just leave them in the comment section of the YouTube page there, and be sure to subscribe to the channel so that you don't miss out on any updates.